The solid tie binding all generations is the ever-worthy question, where do I invest? How can I make a good financial decision? This question has made its way globally and remains unrestrictive to one answer. The fluctuations within international markets and the varying statistics require us to constantly keep up with the trends. Now, obviously, there is a most definite current answer for this question. The emphasis on current here implies that information can be predicted by current data in the present only, and my job here is to provide you with that data so that you can make a proper decision with what to do with your money. To start off, what basically are stocks? When you buy a company's stock, you are purchasing a small piece of that company, called a share. Investors purchase stocks in companies they think will go up in value. Now, moving on to what's happening currently in the Japanese market, and simply to put it, it's a fascinating time to be looking at the Japanese equity market. But what do they have to show for it? With recent changes like an increase in profitability and a friendlier environment for shareholders, one finds the market nothing short of a favorable opportunity to invest. It seems all glitter and gold right now, and for sure, every investor wants to jump on the first chance. What adds to the benefits in the fact that the stocks are cheap and Japan is welcoming of foreign investors, now you must be wondering, what's the catch? Also, to your surprise and mine, Warren Buffett recently visited Tokyo last month where he marked a deal to add to his portfolio of Japanese investments. Buffett, who earlier this year sold his shares in Taiwan Semiconductor Manufacturing Company, or TSMC, just months after acquiring a stake, said, "I feel better about the capital that we've got deployed in Japan than in Taiwan." This event and exchange of confidence by a leading philanthropist and Japan seems very promising. But as a common man investor, is it realistic to follow in the footsteps of a wealthy man with room to take risks? Because statistics show a great downside in investing in the Japanese markets. It's ignorant to not give Japan its well-deserved credit for the efforts, but the success isn't in question. The durability and reliability is in question. Whether the market is flourishing for good or it's going to follow its trend of volatility. Most certainly, Japan is stepping out of its asset price bubble. Basically, during the years 1986 through 1991, Japan faced an economic crisis in which the real estate and stock markets suffered a downfall. By 1990, Nikkei stock index, or stock market index for the Tokyo Stock Exchange, TSE, had fallen to half of its peak and asset prices fell down. On December 30th, 1989, Japan's premier market index, the Nikkei 225, saw a 29% rise and an amazing 15-year climb that helped to put Japan at the center of the global economic map. But in 1990, it fell 39%. Despite innumerable efforts, the market seemed to be exhausted, hitting just 7,054.98 points in March 2009. Over 20 years, the market had fallen 82%. So yes, the promising scope in Japanese market has begun to show only after a 33-year-long recovery. The prominent economic instability only has shown us that the reforms are more talk, less show. Currency risk is also an important factor to keep in mind as an investor, and the falling yen is a red flag for investors since the stocks are bought and sold in the said currency. Also, Japanese government promised the shareholders more rewards and less hoarding of cash, but in 2020, it was recorded that retained earnings had risen steadily, reaching 242 trillion yen, or $2.2 trillion. So the Japan is back announcements are just an attempt to create more noise and attract investors this way. That being said, Korean stocks are steadier, and the profits are extremely impressive. Now, the word steady is important here because the Korean market has been reliable for some time. They have a track record of growth and a stability in economy. Yes, the Japanese market seems all glittery right now, but it might not be as promising in the long run. Or it might be, but better to be a wealthy investor than a lab rat to current trends. For a more apt comparison, let's look at numbers. Korean economy has increased $943.94 billion to $1.63 trillion in 11 years. South Korea is also a member of the Next 11 countries, which is a prediction of it becoming one of the world's largest economies in the 21st century. Korean market has a unique balance of stability and rapid growth rates, which can be said about the Japanese market, and this is the most important and fact worth acknowledging for an investor. It is estimated by the International Monetary Fund that by 2026, South Korea will be 12% ahead of Japan. What makes this event all the more important and illuminating is that South Korea shares so many of Japan's structural flaws. South Korea's ability to fix those flaws provides lessons for Japan. If you're looking to invest right now, invest in a market that has proven its worth and has been doing so for some time. Because as astonishing as the Japanese market has been, a great spike can also lead to a drastic downfall. But an investment is a decision that needs guarantee governed by facts and precision. So the question remains that no matter how beneficial the Japanese market seems, would the investment be sustainable? Would it be a once-in-a-lifetime opportunity? Because, let's face it, none of us have got money to lose. Japan's progressive reforms aiming to benefit shareholders and the highest relative EPS growth is impressive, but hasn't played out yet. Meaning, a trend is worthy of investment if it's steady and it's susceptible to any external influence. The revolutionary change is all talk currently with minimal credibility. But what we know is that the earnings for South Korean listed companies have grown 30% per year over the last 3 years. Revenues for these companies have grown 14% per year. This means that more sales are being generated by these companies overall, and subsequently, their profits are increasing too. Korean government's policies favor investors. Their primary aim is to support innovation and growth. The reforms directly favor the climate within a stock market for investors to put their favorable foot forward and take a leap of faith. The policies include promoting foreign direct investment and establishment of organizations like Korea Trade Investment Promotions Agency, or KOTRA, to help investors navigate through the market. Korean policies also have a reduced corporate tax rate, which is lower than Japan. Summing up, South Korea, without a doubt, has one of the largest markets in Asia with a huge ground to offer to foreign investors. The dual economy and variety of cutting-edge companies like Samsung Electronics and LG Electronics have a great global scope. By investing in South Korean market, you also offer yourself the chance to diversify your investment portfolio. This makes sure that you have assets in different markets and reduces the chance of a major loss. So make an informed decision and invest in Korean market.